Welcome to the Opening Bell Report.
Today we're standing right at the intersection of, well, meteorology and high finance. And let me tell you, it is absolutely storming out there.
It really is. And for once, we're not speaking metaphorically about some, market storm. We're talking about actual snow, actual ice, and just freezing temperatures.
Right. We're talking a literal bomb cyclone, an Arctic blast. It's the kind of weather that freezes your pipes, shuts down airports, and makes you really regret not buying that heavier coat. But while most people are just trying to keep the house warm, the financial world is glued to the charts because this weather system just triggered one of the most volatile, dangerous, and potentially profitable trades in the market.
We are talking about the Widowmaker.
The Widowmaker.
Yeah.
I love that name. It sounds like a villain from a movie, but it's really the nickname for trading natural gas.
It is.
And specifically today, we are diving deep into the United States Natural Gas Fund, ticker symbol UNG.
It's a fitting nickname. I mean, natural gas is notoriously volatile. It has wiped out fortunes just as quickly as it's made them.
Yeah.
And what caught our attention and why we're digging in today, Tuesday, January 20th, 2026, is that UNG just ripped 20% in a single session.
20% in one day.
Right.
I mean, that is not a normal move for a commodity fund. That's crypto-level volatility.
Exactly. And that brings us to the mission for this deep dive. We've got an analysis report in front of us, and it's titled The Perfect Storm Setup.
Okay.
So our goal is to unpack this report and answer the big question. Is this just a temporary panic because it's cold outside? Or is this a legitimate technical breakout that suggests, the Widowmaker trade is back from the dead?
So we've got this report to guide us. It's got everything in it. Weather maps, competitive breakdowns, some really compelling technical charts. But before we get to the lines on the graph, I have to challenge the premise. I mean, it's January. It's supposed to be cold. Why is the market freaking out now?
That is the right question to ask. You'd think winter is priced in, right?
You would think.
But markets move on expectations versus reality. And for the last couple of months, the bears, the people betting the price would go down, they were completely in control.
Why?
Because the winter was just incredibly mild.
Right. I remember wearing a T-shirt in December. It felt like the whole heating season was just canceled.
Exactly. So the market priced in a mild winter. Natural gas prices dropped because, well, nobody needed to crank up the heat. The expectation was set, low demand, lots of supply.
Okay.
But as this analysis points out, the forecast has suddenly flipped. We aren't just looking at a cold snap, we're looking at an Arctic blast scheduled to sweep right across the Midwest and the Northeast.
And those are the regions that really matter, right? I mean, if it's cold in the desert, nobody really cares.
Precisely. The Northeast and Midwest are where the population density is, and more importantly, where all the furnaces are. When those regions freeze, the burn rate for natural gas doesn't just go up, it goes vertical.
Okay, so suddenly everyone turns up the dial at the exact same time. Demand is skyrocketing. But what about supply? I thought we were the biggest producer of natural gas in the world. Can't they just, pump more? Open the valves.
That's the other half of this perfect storm. The report notes that production has been flat. You have to understand, you can't just snap your fingers and increase natural gas production overnight.
Right.
Drills take time. Wells take time to come online. So the supply curve is essentially fixed, at least in the short term.
So when you have a massive shock to demand, meaning a totally flat supply curve.
Simple economics. The price has only one direction to go.
Up. And that's the macro catalyst. That's the spark that lit the fuse on that 20% explosion.
Correct. But this is where we have to be careful. Just because the price of gas is going up, that doesn't mean every investment related to gas is a good buy.
This is the part of the report I found really interesting. Because I think a lot of retail traders, let's just call them the dumb money for a second, they usually gravitate towards the flashiest option. The report compares 3 different tickers: UNG, BOYL, and COLD.
And this is critical. This is the competitive analysis piece.
So the report calls UNG the smart money choice. But if I go on social media, all I see is people talking about BOYL. Why is that?
It's the allure of leverage. BOYL is the Ultra Bloomberg Natural Gas ETF. It offers 2x daily leverage. So in theory, if natural gas goes up 10%, BOYL should go up 20.
Which sounds great. I mean, if I'm bullish, why wouldn't I want double the profits? The report calls BOYL the greedy play. Why is it so dangerous?
It is the greedy play, but it's also the risky play because of a concept called volatility drag. And this is something a lot of retail traders either overlook or just they don't understand it.
Okay, let's unpack that because volatility drag sounds like a term from a physics class. How does it actually steal your money?
Let's do the math. Leveraged ETFs, like BOYL, they rebalance daily to maintain that 2x ratio. If the market goes straight up, they work beautifully. But if the weather report changes tomorrow, say the model shifts, and the cold front isn't quite as severe, and the price of gas starts chopping sideways.
So it goes up a bit, then down a bit, then up a bit.
Exactly. Let's say you have $100. If the market drops 10% one day, you go down to 90. To get back to 100 the next day, you need a gain of about 11.1%.
Right, a bigger percentage.
But with leverage, those swings are magnified. So if you take a big hit on day one, the hole you have to dig out of on day two is even deeper. Over time, in a choppy market, you can actually lose money in a leveraged fund, even if the underlying asset goes nowhere.
So the price of gas could be exactly the same on Friday as it was on Monday, but my BIL holding is actually worth less just because of the chop in between.
Precisely. That is the decay. And on top of that, the report mentions the premium.
Right, it's expensive to even buy it right now.
It's currently trading at what the report calls a massive premium, about 2.5% above its net asset value, its NAV.
So you're paying a surcharge just to get in the door.
You're paying $1.02 for a dollar's worth of assets. It's just inefficient.
Okay.
Now contrast that with UNG. The report calls UNG the safe play. It gives you one-to-one exposure, no leverage.
So if gas goes up 10%, UNG goes up 10%. Simple.
Right. And its premium is only plus 0.7%, which the report considers fair. But the key insight here is that if the market goes sideways, if you get volatility without direction, UNG holds its ground way better than Boyle. It doesn't suffer from that leverage decay.
So the smart money is saying, look, I want exposure to the cold weather, but I don't want to get eaten alive if the chart gets choppy.
Exactly. It's all about risk-adjusted returns. And just to complete the picture, the report does mention KOLD.
KLD with a K.
That's the 2x bear fund. It moves inversely to gas prices. The report just calls it the loser. Well, it took a 40% haircut. If you were holding KLD betting on a mild winter, you just lost nearly half your money in one spike.
Ouch. That is painful. So KLD is out. Boyle is for the greedy gamblers who ignore the math, and UNG is the professionals' swing trade. That's the verdict here.
That is the consensus of this analysis, yes.
Okay, so let's look under the hood of UNG itself, because I think there's a misconception that when you buy UNG, you're buying like a share of a tank of gas somewhere in Texas.
Right. You are not buying physical gas. UNG doesn't sell widgets or store gas canisters. It deals in futures contracts.
And this is where it gets a little technical, but we have to explain it because the report lists it as a kind of bad news, good news situation. The bad news is something called contango.
Contango. It sounds like a dance, but it's really a market condition. It's the profitability paradox of funds like UNG.
Okay.
Basically, UNG owns futures contracts that are about to expire. They have to sell those contracts and then buy new ones for the next month just to keep the fund going. This is called rolling the position.
Okay, so I sell my January contract and I buy a February contract. Simple enough.
Right. But in contango, the future contracts are more expensive than the current ones. The report uses a great analogy for this. It's like selling your car for $5,000 and then having to immediately buy the exact same car back for $6,000.
That sounds like a terrible business model. You're losing $1,000 every time you swap cars just to stay on the road.
Exactly. It eats money, as the report puts it. This is called negative roll yield. And historically, this has been the biggest criticism of UNG. It's why people say you can't hold it long term, because the fund just naturally decays over time from this cost.
So that's the bad news. And usually that's where the conversation ends. Don't buy UNG, contango will kill you. But the report says there's a twist this time. The good news, cash yield. What's changed?
Interest rates.
The macro environment again.
Exactly. To trade these futures, UNG has to hold a massive amount of cash collateral. They keep this money in U.S. Treasuries. 2 years ago, when interest rates were near zero, that cash earned nothing. It was just dead weight. But today,
Rates are much higher.
that pile of cash is earning a 4 to 5% yield just for existing.
That's huge. So the fund itself is actually generating income now.
It's significant. The report's verdict is that this interest income is currently acting as a buffer against that negative roll yield. It's offsetting the cost of selling the cheap car and buying the expensive one.
So sticking with the car analogy, the dealership rips you off for $1,000 on the trade-in, but the bank pays you $1,000 in interest while you're waiting in the lobby.
Roughly, yes.
Yeah.
It starts to balance out. And that makes holding UNG for a 2 to 3 week swing trade much, much safer than it was a few years ago. You're not fighting the current as hard.
That's a really crucial nuance. It's not just about the weather. It's about the financial structure of the fund itself being more favorable.
It's what transforms this from a pure gamble into a calculated setup.
Okay, let's move to the visuals. I'm a visual learner. The report describes a chart setup that technicians dream about. They're calling it a double bottom. Paint the picture for us.
Okay, imagine the price chart of UNG over the last month or so. Back in December, the price dropped down and it hit a low of $9.96. We'll call that low number 1.
Okay, so effectively $10. That's a big psychological number 2.
Huge psychological support. Then it rallied a bit, came back down last week, and hit $10 exactly. That is low number 2.
So it hit the floor twice and it didn't break through.
Precisely. It found support. It literally looks like a W on the chart. Now, the top of that W, that middle peak, is called the neckline. And in this case, the neckline was sitting at $11.50.
And the report says yesterday we gapped over that neckline.
We didn't just cross it, we jumped over it on massive volume. And that confirms the breakout. When you see a double bottom confirmed like that, technical analysts use a specific formula to predict where the price might go next.
Wait, there's a formula. It's not just looking at squiggly lines and guessing.
No, it's geometry. You take the height of the pattern. So the neckline, $11.50 minus the low, $10. That gives you a height of $1.50.
Okay, $1.50. Got it.
Then you just add that height to the breakout point. So $11.50 plus $1.50 gives you a short-term target of $13.
So just based on the mechanics of that chart, the algorithm suggests we're heading to $13.
That is the conservative technical target. But the report does mention a blue sky potential.
Blue sky. I like the sound of that.
If this Arctic blast really holds and panic sets in, there's a gap on the chart. An empty space where the price fell hard before that could allow UNG to run all the way up to $14.75.
Wow, that is some serious upside from here. We're talking another 15–20% run potentially.
Which, in the world of commodities, is a massive move.
But, and there's always a but, we have to talk about discipline. This is the Widowmaker after all. We can't just throw money at it and hope. The report lays out a very specific trade plan.
Yes, and this is where the smart money really distinguishes itself from the retail FOMO. A novice trader sees that breakout and just buys immediately at the top, terrified of missing out.
Buy high, the classic mistake. I've definitely been there.
Right. The report advises patience. It identifies a golden zone for buying. They're looking for a pullback, a retest of that breakout level, specifically between $11.80 and $12.
So you wait for the price to cool off a tiny bit, come back down to check that $11.80 level to see if the old ceiling has become the new floor, and that's where you strike.
Exactly. You want to buy the dip, not the rip.
And what about protection? Because if the weatherman is wrong and it turns out to be 60 degrees in Chicago next week, this whole thing collapses.
And that's why the stop loss is non-negotiable. The report states that a close below $11.20 invalidates the entire thesis.
$11.20.
If it drops below that, the double bottom is broken, the support is gone, and you get out. No questions asked.
That is the hardest part for people, isn't it? Admitting you were wrong and just taking the loss?
It is. But in trading natural gas, hope is not a strategy. You take the small loss and you live to fight another day.
And on the upside, when do we cash out?
The plan suggests taking profits at $13.50. That's a bit above the technical target, capturing that momentum. And then if you're feeling bold, you leave a runner, a small part of your position, to see if it can hit that $14.50 level.
I like that strategy. You secure the bag at $13.50 and you let the rest ride on house money.
It's a disciplined approach to a very chaotic market.
You know, the report ends with this philosophy that I think is so powerful for anyone trading commodities, but especially natural gas. It says, do not marry this trade. Date it for the cold weather, then dump it before the thaw.
It sounds ruthless, but it's absolutely necessary. Natural gas doesn't care about your portfolio. It doesn't care about your analysis. It cares about the temperature and the pipelines.
Right.
This is a trade based on a specific event, this Arctic blast. Once that event passes, or thaws, the reason for holding the trade just evaporates.
And if you marry it, you're the one holding the bag when spring comes.
And with the Widowmaker, that divorce is usually very expensive.
So let's just recap what we've unpacked. We have a macro catalyst, the bomb cyclone, creating a demand shock against flat supply.
We have the competitive analysis. UNG is the safer, smarter play over the leveraged BOIL, thanks to its fair premium and that lack of volatility drag.
We have the financial health check. High interest rates are providing a cash yield that's buffering the usual rot of contango.
And finally, we have the technical setup. A textbook double bottom breakout targeting $13, potentially higher, as long as we buy in that 1180 zone and stop out at 1120.
It really does sound like a perfect storm.
It's the convergence of fundamentals, technicals, and macroeconomics. It's actually rare to see them line up so cleanly.
But as we wrap up, I have to ask, what's the one thing that could wreck this whole beautiful picture? Because I know there's always something lurking.
It's what we touched on earlier. It's the volatility of the data itself. What's so fascinating here is how fragile certainty is in this market. Right now, the computer models say Arctic blast, but meteorology is about probability. not certainty. If one major weather model updates tomorrow morning and pushes that cold front, say 500 miles east, out over the Atlantic instead of over the Northeast,
This demand spike just disappears.
instantly. And the smart money that piled in yesterday, they will flip and short this market before you can even open your brokerage app. That's the danger. You're trading a weather forecast, and weather forecasts can change on a dime.
That is a sobering thought. We're essentially betting on the wind.
In a way, yes. But that's why we have stop losses. That 1120 level isn't just a number on a chart, it's your ejection seat.
True. Well, for everyone listening, keep one eye on the thermometer and your other eye on that 1120 level. It's going to be a wild couple of weeks in the energy markets.
Stay warm and stay disciplined.
Thanks for joining.
Don't forget to like, share, and subscribe for more.